Ladies and gents, hello, welcome back to another video. Thank you for tuning in as always. And in this video, we're going to talk about ROI, Return On Investment.
What's your return on investment?
Which is something that I've talked about in previous videos, but not really gone into too much detail. I haven't told you why I use it, how I calculate it, and what I look for as a percentage. So in this video, we're going to do it. Now, what do we know about ROI? We know return on investment is used by calculating the annual profit of your property per year. You divide that by the amount that you invested in the first instance, and then you times that by 100 to give you your percentage. And that right there is your return on investment calculation. Now, rather than leaving this video at that, I'm obviously going to take you through a live example, which I've just drawn out and have already prepared for you. So in this example, I've taken a £65,000 house. I've then assumed that if it's a 2 or 3 bed property that's done to a reasonable spec, that should be able to get in the ballpark of 500 to 550. But for this argument's sake, to keep it simple, we'll work off of 550. Now from here, if you've bought this property at 65 grand and it's a great rental property, ready to go, doesn't need much work, then you're going to put down a deposit most likely of 25%, which would be £16,250. And then following that, I've just put down some different calculations to help us with this example for solicitors, survey, stamp duty, land tax, because you still have to pay the 3% surcharge, and then any updates just to make the property compliant. So if you use this example, we've got a total of £20,500 as the total cost or investment initially to get the property purchased and set up. Now, if we take the £550 rent per month, we're going to look at the monthly expenses. Now, the £550, you would then deduct the following fees. So mortgage, depending on the rate that you manage to secure and depending how much you put down as a deposit. But as I say, for this example, it will be in the range of 150 to 180, depending on the rate that you secure and lock in. But in this example, I'm using £160. I'm then using a managing agent because I live far away, so I'm going to employ a managing agent to look after the property for me, which could range anywhere between £60, £70 or so, and therefore £66 I put down as the managing agent fee. And then finally, insurance. We want to have building insurance, content insurance and public liability insurance just to cover ourselves as landlords. So I put down £25 a month, which is approximately what I pay on my house in Liverpool at the moment. Moving on. That will give us a total of £299 monthly profit once we've deducted all of those off of the rental income. We then times that by 12 to give us our year's rent, which works out as £3,588, and then divide that by the initial cost of purchasing and setting up the property. Times that by 100 to give us our percentage, and therefore this property, this example, gives us 17.5% ROI. Which in my experience and so far, and my examples of what I'm looking at, that's a good ROI percentage. I've always said I want 17, 18, 19% upwards. If a property is ready to go, that's what I look for in a house. Now, if you're to take this a step further and really scrutinise whether this is a good ROI, you're probably not going to always get the 17.5% ROI. If you really want to scrutinise it and see how good this is as an investment compared to other investments that you might have, this is how someone would then perhaps take it a step further. So again, you might even look to keep a maintenance budget aside of £50 a month, or it might even cost you that. So whether you're putting aside or spending it, £50 per month for maintenance would then instead leave you with £249 profit per month. You might even then times that by 11 instead of 12 to account for a void month during the year. And instead of the £3,500, that's now giving you £2,739 as your annual profit per year. I do the same calculation and it gives you a 13% ROI, which once you've deducted all of that is still a good ROI percentage when you compare it to other investments that are out there, and you may well have capital appreciation on your property as well. Now, just one more thing, as people love to bring up that I don't include tax costs. That's because everyone has a different tax code or tax amount depending what they earn, if they're buying in their own name or if they're buying in a company, depending what revenue streams they have going into that company. So in this example, we don't include tax, or I don't include tax. I don't include accounting fees because, again, if you've got multiple properties, you're dividing your accounting fees up between those multiple properties or multiple revenue streams. There's no point including it for you because that would be completely irrelevant for you right now, because that's all individual and that's something that you should work out for yourself after you've done all of these calculations. So I hope that's helpful. Now, if you've heard the term infinite ROI, that's thrown around quite a bit. You know, someone might say, I bought a property and it offers infinite ROI, infinite return on investment. It sounds a bit unbelievable, but it is possible. Now, the way that's possible is, for example, if we had bought this property and it needed work doing to it, and in these sums we included a refurb cost. So if we bought it for 65 and then spent 10,000 on the refurb and then pushed the value up enough where you could pull all of your money out of that investment once you've refinanced it, if you were to pull all of the initial investment out, then you leave yourself with what's known as an infinite ROI. As I've mentioned already, when I'm looking for a property and I'm looking for something that's around the 20% mark or just under, that's a house that's ready to go. When I say I would like to find a house that's 30% ROI, I'm thinking of a house that might need updating, refinancing, and that I might have to leave 10, 15,000 in and then move on to the next one. So that's when I say I'm looking for a 30% ROI, that's what I mean. I assume that I will be able to add some value, but I won't be able to take out the full investment cost by doing the BRRR model. Now, just one final thing to note is that when you're purchasing a property in the area that I'm currently buying, it's a high yield area. Low cost purchase price, high yield, meaning that the ROI is 15%, 17%, 20%, so on. However, when you're looking at properties that maybe are in the south of England, maybe they're around London, and perhaps they cost a lot more in order to purchase them in the first place, and the rental income doesn't quite match up as much, then the ROI is going to be lower. It's quite typical for properties like that to be 5 to 7% or 7 to 10% ROI. However, they're much more likely to appreciate when it comes to the capital value. So it all comes to balancing out, what are you looking for in a buy-to-let investment? Do you want high monthly cash flow, or do you want capital appreciation over time? Or ideally, finding some middle ground between the both is probably the best thing you can do. Now, I hope this video was useful. Please give it a like if you've enjoyed it and found it useful. Of course, everyone has a different way of working out their ROI, their return on investment, the yield calculations. But this is the way I like to do it, to work out how effective my investment was. So I'm hopeful that you can do the same. Thanks for watching once again, and I will see you very soon.
Okay, I've been working like 3 jobs. Probably why I never see ya. Probably why I never have time for the fake friends that won't be ya. Oh God, I've been running now. Up early when the sun is out. Not setting out my own soul, but those real ones, they coming out.